Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello and welcome, everybody. Welcome back to another episode of Keen on Retirement. Glad you're all here, and Bill and Matt, glad you guys are here as well. How you doing?
Yeah, well, good that we are here because we are the program, aren't we? I guess someday one of us might drop off, but hopefully not anytime soon, you know?
It sounds official, the program.
Yes. Yes, of course. Yeah, we have a fine financial program here that's been in production now in its 11th year, right? Are we in our 11th year, I think? Yeah.
Yeah.
Yeah, that's pretty
2015,
impressive.
I think. Yeah.
That's right.
Oh, yeah. Yeah, that's pretty impressive for a podcast. I think one time we talked about that on one of our kind of anniversary shows, if you will, maybe the 100th episode or 200th. And I think we did some research and saw that most podcasts didn't make it past, 7 episodes or something?
Yeah.
Yeah. So, well,
Yeah.
we're committed. We're fully committed here, aren't we? Never missed an episode in all those years. So.
Either that or we'd love to hear ourselves talk.
That's right. Yeah.
That's right. And, now we're on YouTube this last couple of years.
Yes.
So I get reports from listeners and viewers, I should say, great clients and friends of our firm that tell us that they actually watch the episodes on like their televisions, like they cast them from their phones to their maybe Apple TVs or something.
Yeah.
Makes it easier than sitting watching it on a phone or having to be at a computer. So I think it's great with technology. We've been able to put that out there on YouTube, and we've been able to do things like hold up Matt's Dow 100,000 hat and get a visual of that. Or, Matt, you can go ahead and do that if you'd like. I know this is
there it is
off script here. Not that we have a script.
There it is. Can you?
I think it's probably a good time for Matt to don that hat today with the volatility we've seen in the markets here just recently. Not horrible, but
I know. We were just talking about Dow 100,000. Everyone forgets that.
I know. And we passed through 50, and we had a couple days above 50. And no, it's just a matter of time. We know whether it's 5 years, 6 years, 7 years. I mean, Trump said, what did he say? It's going to be 2 years. I'm not sure it'll be 2 years, but 2 or 3 years. But, my bet's about 7 years or so. But anyway, I'm glad you pulled the hat out. While we're talking on the camera, I forgot to mention this to you and our viewers and listeners before. I've got some currency here from Australia. Do you see this?
Oh,
these are $5 bills from Australia. I've got a couple of them that I have left.
Is that the Queen of England?
Yeah, it certainly is. Of course it is. Yeah, it surely is on these bills. And I was just noting this, and I could call this an investment because when I left Australia, Australian dollar was 0.66 to the U.S. dollar. Today it's 0.71. So it's been increasing against the U.S. dollar.
Okay.
Not sure how relevant
Time to
all
go
that
back
is.
and spend that money.
Not sure how relevant. Yes, exactly. Not sure how relevant that is to our listeners today, but it was an interesting something for me to show on the camera since we were talking about our cameras and YouTube.
Yeah.
Well, and just maybe to make something financially relevant out of that dollar thing, when you are, and you guys can explain this, but when you invest in foreign-based companies, there's a currency translation effect. And so like here in the US, we don't have to worry about it because it's all in dollars. But if you're investing in a company that may be using the euro, for example, if the dollar strengthens or weakens, you talk to me about the impact of currency translation. And is that something that investors should even think about?
Oh, yeah. Yeah. Well, one of the world's famous investors, Warren Buffett, of course, he retired at the end of 2025. So he's still chairman of the board, just not CEO anymore. But they I think they just came out with their financial results and one of the things that was a significant impairment to their results was the adjustment for currency. So I think they had, I can't remember the exact dollar amount, but it was enough to where it looked worse than it really was because, sometimes it goes with you, sometimes it goes against you. But anytime you have, any transaction. So some companies, even though they're headquartered here in the U.S., have they have business overseas. And so that those funds, as they get converted back to US dollars, there's a cost to do that. And there's risk of fluctuation for that, conversion, or just holding that currency versus dollars. So it's definitely one of the drivers of returns for foreign assets.
Oh, for sure. Drivers or lack of driver, you
Yeah.
know, well, however you look at it, right. Since I've been in the industry almost 35 years now,
Mhm.
and I can remember even, early on, we would talk about, and I think today it's even more so, that sometimes keeping it simple and investing in US based companies that, yes, have
Uh-huh.
sales overseas. They have a lot of sales overseas. I mean, you think about some of the major companies, but you're not having to worry about that currency risk if you own a US based company, but you're getting exposure to the international markets because they are
Yeah.
doing business all across the planet. And I'm not sure, have you seen a number, Matt, recently on what the actual, let's say the S&P 500, how much of those US based companies revenue is derived from overseas?
I want to say I haven't seen any updates to this recently that I can, quote confidently, but I recall, something like half in the
Yeah,
past. I mean, there's a good portion. Now, the currency risk isn't eliminated just because you invest. It's just the company now has to deal with it. So
that's right.
it
That's
still
right.
exists. It's just less so than a foreign headquartered company would have. So yeah,
That's right.
definitely a consideration. Yep.
Yeah. And given how much people like to invest and speculate, I think the currency market is actually one of the
Oh yeah.
largest financial markets in the world, where you have institutional investors that are just buying and trading and hedging
Uh-huh.
through currency futures and swaps and whatnot. I mean, that stuff gets pretty sophisticated and carry trades. I mean, not anything that most of our listeners need to be concerned about or worried about, but there's a huge, huge market of people that just trade currencies and the
Yes.
relative value of one currency against another. And I think this currency is going to appreciate against the dollar or against the euro or depreciate. And I'm going to make this bet. And yeah, it's there's an opportunity to invest and speculate to fulfill any person's desire. That's for sure.
Yes. We would not
Oh,
recommend anyone do
Yeah.
that, to speculate in foreign currencies, because you could actually end up owing money if you don't do it correctly. So
Yeah.
right. You
there
actually can
is,
lose more than you invest, right,
yeah,
Matt?
I mean,
If you're on leverage
you
with futures.
could. I mean,
Yeah,
most of these custodians or trading platforms
of
really
course.
don't let new people put
That's
themselves
right.
in those positions, but
That's
just
right.
be aware of what you're getting yourself into.
Right. But well, maybe we should talk about prediction markets then, in terms of
Sure.
yeah. We'll save that for another podcast
I know there's
episode.
a
But
lot with that too.
uh,
And,
oh yeah, yeah,
Well,
we were talking
prediction
about that.
markets, I mean, you're seeing them come out on financial apps. I know you said a different episode, but maybe until we transition in, we're going to do a listener question episode today, which are always
Yes,
some of our most
yeah.
we
favorite.
always get to the actual episode at some point.
We do, but the
Uh,
reports I get from clients is they do appreciate, and listeners, they appreciate a little bit of the banter up front because it's really off the cuff and organic,
Mhm.
and things that we are seeing in the firm, but organically comes up as we speak. And Steve, you're so spoken and street smart and everything else. We get a lot of compliments on you too, sir. So it's
Thank you.
great. But you look at there's these financial apps that are now putting true betting. You can bet on anything. I mean, of course, there's the sports books are all out there now, but actually on financial apps, right? I mean, they're allowing you to bet on who will be the president next. I mean, all kinds of things. I think everything,
Mm,
which
pretty
is
much
not,
everything.
I mean,
Yeah.
seriously, that does
Yeah.
not engender the good long-term patient um, processes that we purport that will get someone to their destination long-term. It actually is the opposite. It's hitting dopamine sites in the brain that do not support being a solid long-term investor.
Yeah.
But again, like you said, another episode maybe down the road, because it's training our younger people. That's the thing I'm afraid of. It's training our younger people to think there's some shortcut that just seriously, I mean, the worst thing that can happen is you can go to the casino or do one of these things and you can win. That's the worst thing that can happen,
Mhm.
is you can do one and win, because then you think you can up your bets and
Yeah.
before it finally takes all your money. So I'm not trying to be a naysayer here. I'm just saying it's not really worth it. So entertainment value, maybe, but not long term.
Yeah. All right. Well, great. Well, let's jump into a few of the questions that we've got here today. And you guys recently did a webinar on the 4 stages of retirement and had a few good questions that came up through that. So we want to go through some of those. And the first one here is from Mike. And he says, I have RSUs vesting, so restricted stock units vesting through my employer. And I also participate in a non-qualified pension plan. As I approach retirement, what should I be doing with both of these? And how do pension withholdings work? So a lot in that question there. So what are your thoughts here?
Yeah. Let's start with the RSUs. And, that is something we haven't discussed a whole lot, on our podcast episode. So as Steve mentioned, RSUs are restricted stock units, and really they're a form of compensation that a company, typically a publicly traded company, can provide to their employees. Now, it comes with some unique tax ramifications. So for one, they're taxed twice. So upon vesting, so this is, essentially what happens is you get awarded this, what they call restricted stock. So you can't do anything with it until it vests, which is, a way for the company to say, hey, we're going to give you this benefit, but you've got to work here for so long until you're able to be eligible to receive it. So that's what this vesting schedule is. And that and they can come every single time. Like each award would have its own vesting schedule, different than like a 401k vesting schedule, because once you're vested, you're good to go. But once they vest, no matter, you get the share, so you get that stock, and you could sell it right away, or you could hold on to it. Those are your two choices. But when they vest, they're taxed as ordinary income.
Okay.
And that's and it's like working income, like compensation. So you're subject to FICA tax, all of that.
Yeah, which is very different than paying long-term capital gains, or which is lower.
Yeah. Then if you sell it right away, well, you probably wouldn't have any gains. So it's just cash. Or you could then hold on to it, and then it's subject to short or long-term capital gains, and that's only on the difference though. So it's only because you have the basis for what you paid, and then, the difference on the gain. So
what happens, Matt, if it vests at, let's say it vests at $100 a share,
yes,
you have to pay ordinary income tax at $100 a share, and you don't sell it right away, and then the stock drops to $80 a share, and now you're retiring or you decide to leave the company, and you have to sell at 80. So it's not a good deal, right? Because I paid tax at $100 and then I sell it at 80. So now, I get a double negative whammy there.
I mean, it's like, because you could have converted it to cash, right? So it's like you have it's because they're taxing it as if you got paid it, but you got paid it in stock. And and the idea being, well, if they were awarded and the company's doing well, and maybe it was a 3-year vest, well, they could have been awarded and it's performed really well too. Like you got a lot of units, relative to what the value you're receiving. But you do pay tax, and most organizations, most companies allow you to, do a cashless exercise where they'll sell the shares to cover the tax, but it's a static withholding. So even though you're covering the tax, it still not be what you owe, because you're taxed at whatever your income bracket is. The IRS just says, well, these are like a bonus, so we're going to just withhold 22% across the board, which may be too much, maybe not enough. I mean, for most people in this situation, it's probably not enough. So be aware of that if you do have these, that you're going to have to still do some tax analysis to determine how much tax you really owe.
Mm-hmm.
The other aspect to it then is like, okay, well, is in Mike's question where he's talking about getting closer to retirement and everything else. It's like, okay, well, if you're getting these shares and they're vesting, another consideration is sometimes companies will have a vest upon retirement type. So
Sure.
you basically kind of get a benefit there, and it might vest 6 months prior to retirement, depending on the company. And so you're going to have all of that maybe hit in 1 year. So you might have a very high tax year that year. So, what we always look at from a planning standpoint is, okay, well, while you're working and maybe having this extra income, and we would most likely be recommending that you sell those shares as they vest, depending on how much exposure you have to the company, because
Right.
just continuing to get more is just generally not advisable, because that's a lot of risk tied up in one company. So if you're selling shares, maybe you have capital gains. So how do we minimize that? Well, for one, we'd look at maximizing your retirement plan. So can we increase how much you're saving, maybe on a pre-tax basis, to lower your ordinary income? And then two, we'd look at any charitable giving strategies, if that's important to you, because, well, instead of selling the shares, we could donate appreciated shares to donor advised, funds, things like that,
Mm-hmm.
that would help mitigate some of the capital gains tax as well. And then in Steve's situation, where if you had a loss, can we at least harvest some of those losses and use them to offset gains, whether they're in different, different lots, because depending on how long you work somewhere, you might have a lot of this stock, and maybe new shares are at a loss, but old shares have a big gain. So how do we offset all of that? So a lot of different planning strategies when it comes to these things.
Oh, yes. Yeah. And I want to make sure I said that right, because as I listen to you talk, when these vest, they're taxed as ordinary income. Although once you own the shares, of course, if you hold them less than a year, they would incur short-term capital gains.
Yeah, or subject to them if they had a gain.
Yeah, if they had a gain. And if you hold them more than a year, they actually do get long-term capital gains treatment. But
That's
what I
right.
was speaking of earlier was when they vested, that piece of it is ordinary income. If you hold it for those time periods, then it is cap gain. So it's a little bit of both there, isn't it?
Yep,
I want
that's
to make
right.
sure I said that right. Yeah, so very interesting. A lot of folks see these as part of something being handed out in the tech industry. It is actually yes, a lot in the tech industry, but other industries as well. So interesting question. I'm trying to think, did we answer his entire question?
Well, he has more, because he also
right.
said he participated in a non-qualified pension, which another way of really kind of probably saying a non-qualified deferred comp plan. And what those are put in place where IRS allows this. This is all above board, but they're plans that are designed for high income earners who have income above like the limits for 401ks and these qualified type plans.
Mm-hmm.
So the employer, though, still might say, we want to provide an additional benefit to our highly compensated people. And, sometimes, and you may not know if you have this or not, just because you're not, up to speed on kind of all the different nuances with some of these retirement plans or types of different benefit type plans. So if you have something that's called like an excess benefit or a supplemental executive retirement plan, like that's a real common phrase we hear as a SERP.
SERP.
Yeah, that's basically what this is. So it's non-qualified. So the main issue with that is you are a creditor to the company. So a qualified plan is, it's your money, assuming it's all vested, everything's your money, and it's segregated from the assets of the business. Like a 401k is not subject to creditors, anything, if the business had any issues. Now, a non-qualified plan, especially these, are subject to creditors. So just something to be aware of. And so the reason they kind of look at it that way is because, well, you're deferring, or the company on your behalf is deferring receiving this compensation to some point in the future. So you are not taking receipt of it. So it's not taxable till it's received in the future. But to really qualify for that deferral of tax in this situation, especially when it's something that's provided to you, is it's at risk.
Oh, yeah.
So that's where this non-qualified kind of piece comes into it. Kind of some nuance there with some of this stuff. But one of the key things with that is, well, a lot of times with these non-qualified plans, you get to choose a distribution schedule. And you typically have to choose that at time of election, but sometimes it can be, at some point before retirement. But they're not necessarily changeable. Most of these distribution choices are, you get one pick and you don't get to change it. And commonly it's 1 year, 5 year, or 10 years. Those are usually the most common choices. And the important piece is to understand, well, if you did choose a 10-year period, I mean, your benefit is still subject to creditors, if the company went away. So the longer you spread this out, it might be better from a tax standpoint, but maybe not from a risk standpoint.
Right.
You are taxed in the state of residence when you receive the payment. So if you choose a 10-year payment schedule, you get that benefit. So if you happen to be in Kansas when you earned the income or where you worked, but then moved to Florida when you received the income, well, then you'd be taxed as a Florida resident instead of a Kansas resident. Any schedule that's less than 10 years, then you're taxed at the state level where you earned the income. So in my previous example, you'd be, no matter where you lived, you'd be taxed in the state of Kansas because that's where you earned it. So again, something to be aware of with these non-qualified plans and how the taxes on those things work.
And do you have any sense for our non-qualified deferred comp plans? Are they becoming more popular, less popular, or about the same? I don't know if you have any sense for that.
I'd say they're about the same. I have not seen a bunch of more discussion or companies that are rolling out new versions of these. I mean, just the ones that have them, the ones that don't. I mean, but it's kind of always been about the same.
Yeah. All right.
Yeah. So we're adding some acronyms to our shows. We had a lot of acronyms. So now we have that. There's also LTIP, long-term incentive plan, which can work almost very similarly here to a non-qualified deferred comp plan. But I think it's probably for some of the folks that are in upper management in some cases, where they want to have some alignment. The business wants to have some alignment with the team members, and they want to put some additional layer of compensation in there that they can enjoy. That aligns them with the company's success over time, but also like they lose it if they leave type thing as well. In most cases, right, Matt? Unless you retire, retirement would be a date that it would trigger.
On these plans, I mean, they'd still be subject to like a vesting schedule, but these are kind of excess benefits.
Yes.
So, depending on the company, if it could be provided in stock or cash or things like that, but usually different than like a bonus type plan. So
that's right. And then another thing you didn't mention again is when, let's say you leave the company and you've taken a 5-year or a 10-year payout, what is the money in over that 5 or 10 years? Is it in your company's stock? Is it subject to your company's stock volatility? Or is it and will you get increases if the stock price goes higher or lose if stock price goes lower? Or is it in a fixed account of some sort? Or were you able to diversify it like your 401k? These are all things. You know what? As I think about the way we've answered this question, there's been a lot of capillaries to it. And it's absolutely, this so speaks to why when we sit down with a family, we have to see all of these documents, all of the vesting schedules, the payout dates, the taxation, of each of these things, the liabilities that are associated with them, the diversification or concentration, and literally spend a lot of time with our planning team putting this into a financial plan and really laying it out over the course of the next 1, 3, 5, and 10 years and making sure we have our arms around it. And how does this affect the other benefits, whether it's Social Security or insurance subsidies, or whether it's Medicare, if it goes out past 65, all these things matter. So these are the things that, it's just so critical that we have all that data, so we're able to make it a part of a comprehensive plan and not just answer these questions in the vacuum of that specific issue. So I think that's a good way to maybe tie a bow on that answer, gents.
Yes. All right. We have a question here from Dennis, and Dennis is asking, when I inherit life insurance proceeds from a parent's policy after they pass away, does that money count as taxable income and affect how much of my Social Security gets taxed? And what about the money I invest from that inheritance going forward?
Sure. So easy answer. So if it's term life insurance that you receive, which that's typically what he's referring to, is that is not taxable to the beneficiary. So right there, good, no impact, does not show up on your tax return as, an event that you have to pay taxes on. And then, yes, post receiving those funds, depending on what you do with it, then it's just going to be like any other investment that you had that was outside of a retirement account, subject to, interest or dividends, whatever the tax is on those, capital gains. If you have those inside, that bucket there. So you'd pay tax just like normal, and then your Social Security would be taxed based on whatever it should be based on those calculations. Now there is some kind of aspects with different insurance products that I think is important to to cover here. So, occasionally people have like whole life policies that have a cash value to them, and while term insurance is pretty straightforward, you paid the premium, you passed away, and then the beneficiary gets the the benefit. But with whole life, there's like two pieces. When you're still living, if you have a policy, you'll see this like cash value, and then you'll see the death benefit, which you don't get. It would be what your beneficiaries get. Well, at death, what happens is if you have any cash value left, the insurance company keeps that.
Oh, they pay the face
value. And then the
value,
benefits go to the beneficiaries, the death benefit. But yeah, I don't think everyone realizes that. And, I'm sure the insurance company is, of course, letting out all their policyholders know that to take that out before they pass away, because, they want to make sure that they are all aware of that. But it is something that does happen. So, if you do have a whole life policy or have maybe a family member or a parent that has one, be watching some of that, because you'd hate to have a cash value that maybe is significant, or in some cases, depending on the size of the policy, could be as large as the death benefit. So you've got to kind of understand that. And then there can be different like payment structures. We've seen this with, pretty much any insurance product is like, okay, when the beneficiary, when you get notified that this death benefit is coming, do you want it as a lump sum? Do you want it as as an income stream, which the insurance companies are happy to set up for you? Again, it doesn't change like the taxation of like the principal, but if you chose an annuity payment, like, okay, we're going to get a 5-year payment of this or some schedule, you'll get the return of principal for whatever the amount is that you were to inherit as the insurance benefit. But if it was earning interest, or if it was invested in something and there was a gain, well, that difference between the initial premium and then whatever you received would be taxed as ordinary income. So it's slightly different. I mean, it's typically not a huge amount of tax. It just depends on how long the schedule is and everything else, but something to be aware of when it comes to that.
Yeah, and Matt, do we even care about today talking about if somebody had a taxable estate. If they had that, because this question is asking about how does it affect them? How does it affect Dennis? But if insurance is owned in a
depends on who, how it's owned. That's right.
Irrevocable trust outside the estate, it would avoid estate tax, but there could be some estate tax that's actually assessed on the estate of the person leaving the money. Probably a little bit more advanced there, but I think you answered Dennis's question really well there.
How does this impact Social Security benefits and whether those are taxable?
Just receiving the benefit, since it's non-taxable, no impact whatsoever. It's really what do you do with the money post receiving it that would trigger any tax on Social Security? Because now if you took that money and invested it and then generated a lot of additional interest income or dividends, well, that's now going to then be part of the calculation on whether your Social Security is taxed or not taxed. Just like IRA distributions would be, just like, anything else. So that's the impact comes into play kind of post receiving it. And then what does it generate from a taxable income standpoint? That would then maybe trigger taxes on your Social Security or not. Maybe you're already paying the most, your Social Security is subject to the most amount of tax that it could be, and not going to change that, but just change your tax situation. Now you have all that money you just received, so there's that side of it too. It's not a phantom tax out of nowhere. We'll put it that way.
But the good news here, and really I think his question, the wonderful news, fantastic news, is that the actual amount that you receive from the
inheritance itself,
is tax free.
Does not change. That's right. Anything from your tax standpoint.
Excellent. All right. And our third and final question here today is from David. And he says, if I've been doing smaller Roth conversions each year, starting at age 59, and I know the government uses a 2-year look back for Medicare premiums, meaning you're at age 63, your income affects what I pay at age 65, my Medicare year. Should I skip doing a Roth conversion at age 63 entirely, or is there a specific income threshold that I should stay under?
Yeah. So what David's referring to is this concept called IRMA, Income Related Monthly Adjustment Amount, and that is what your Medicare premiums, they will adjust based on your income if it's over a certain dollar amount, and that's this whole concept of IRMA, and it's based on your income from 2 years ago. So right now, like your 2026 Medicare premiums were based on your tax return from 2024. But it only applies if your income's over the threshold. So if your income never triggered the threshold, you just pay the standard. They wouldn't be alerting you saying you didn't pay, an extra surcharge. It's only when you are subject to the surcharge do they send you a letter and say, hey, based on your income from 2 years ago, your Medicare premium for the next year is going to be higher because of that. And it's a year by year calculation. So if you had a year where you were over the threshold and then the next year you weren't, your premium would go back down. So it's not a, hey, if you triggered it once, you got to pay it for the rest of your life type of situation. So, but what David's really asking is, sounds like he's been very, very good about Roth conversions and kind of thinking about how to handle these. And so he's thinking, okay, well, if I'm 63 this year, I'm planning to go on Medicare at 65, so 2 years in the future. And if he's retired, I take it, or, he's looking at Roth conversions and he just doesn't want to trigger a Medicare surcharge. So what I would say as well, it's not, Roth conversion is not necessarily the yes or no question here. The question is, well, where's the threshold? Because a Roth conversion, what we would say is if you're really concerned about the Medicare thresholds, well, let's convert or look at converting up to that first threshold. And it's right now for this year, it's $109,000 for single filers, $218,000 for joint filers. So, that's kind of, it's a fairly high, but it just depends on your situation. And the very first threshold doesn't trigger like a significant increase in your Medicare. It's, I think, $60 or $80 a person.
Right.
That's on Medicare for each month for the year. So, it's definitely a cost, but it's not huge. But again, it's like one of those things that if you trigger that, people just don't like that. And here's the other thing. It's a cliff trigger too. So it's not marginal. It's just $1 into when you're over, it triggers the entire additional premium. So you do want to be aware of that. So if you're really trying to get real close to that, give yourself some wiggle room just to be on the safe side, because you don't want to go over it. That's again, triggers.
And how much is the IRMA surcharge? Roughly?
So it's variable. So it's based on how much over that you go. So there's different brackets, I guess, or different thresholds to where it'll start at, I believe your first year premium in 2026 would go up to, so this would be, you got the base. So this is the base plus like $284 up to $689 per month, depending on, where that threshold, how much higher you go.
So when you were talking about the cliff, just to make sure I understand this. So joint filer in 2026, it's $218,000. So if you make $218,001,
that's right.
Then you're going to pay an IRMA surcharge. So the base is $284.10 for your Medicare Part B premium. Let's just assume that's the number. If I go $1 over the $218,000, I'm going to pay $284 plus something, another $50 or something, or.
So that was the $284 was with the very first surcharge included.
So
okay. The base premium's it's $202.90.
Okay. So if I go $1 over,
yep.
So if I go $1 over, I'm going to pay
about $82 more, $81.
About $82 extra per month. Okay.
And that's per person. So married couple, if you're both 65 or on Medicare, then you're both paying this. And Part D is also going to increase too. And that's $14.50.
Yeah. Okay. So it more than doubles. If you go way past the $218,000, your Medicare Part B premium could well more than double.
Yes. Like the highest threshold is income over $750,000. So it's really high, but it goes up. The IRMA surcharge is $487.
So $689 total, right? The total payment monthly per person.
And then the Med Part D is $91. So call it $600 a month additional per person.
Mm-hmm.
Is the deal. So if you went over $275,000, then it goes up to $284 is your monthly payment to $405, almost $406. So you can kind of sense that it creeps up there. So it is a means test there.
The
on
thresholds
your
aren't,
Mm-hmm.
Where we look at it, because, in some cases, it may not be something you're ever going to get out of because of the size of your IRA. If your IRA is large enough and the RMDs are going to be significant, it just might be a thing we've got to deal with. As best we can. Yes, we're going to look at Roth conversions, but again, there's a lot of tax analysis that we have to put into play. And two, Roth conversions, while great, there does become a point of diminishing returns. Like too much any one given year, you're paying a lot of tax, and there's a lot of tax, things that we have to know about the future to be as confident with large portions of an account going to the government to pay that tax. So again, just a lot of things to think about. So to answer David's question, so I would say I would still look at Roth conversions. I would just make sure the analysis is looking at where those IRMA thresholds are. So it's, again, not Roth yes or no. It's just, will this Roth conversion, or how much of a Roth conversion can I do before I trigger an IRMA surcharge? And is there an amount of IRMA surcharge I'm okay with? So that's another thing. Because, you got to weigh that too. It's like, if I'm paying a little extra a month for 1 year, maybe, is that okay? relative to what I think I'm going to benefit by putting money in the Roth IRA.
That's right. And Matt, what's your response or opinion to, we've had clients appeal to Medicare. There's a form to fill out. I think it's actually pretty handy now online. You can appeal.
It's not overly difficult. That's right.
So let's say you did this big Roth conversion up into, the second or third Medicare surcharge a couple of years ago, and then you retired this year. So, like this year they're retiring. Do you see any reason why you couldn't send the appeal in and say, I've had a life-changing
downside to because it's not like they're going to charge you any more. They're just going to say yes or no.
I've retired,
but
I was making more.
If you were working and had earned income, and that was in, call it 2024, in 2026, you're paying a higher premium because of that. You can appeal it. It's a life-changing event and saying, I've since retired. And so far, everyone I've talked to that's done that has not had any issue with getting that approved. Because basically what they'll do is they'll ask you, well, what do you expect your income to be this year with all your, retirement, distributions and things. And if you tell them it's going to be below the first threshold, tell them a dollar amount that's below that, then they'll just tell you that you pay the standard, the base, premium. Now, of course, they'll catch it up when you file your taxes. So if you happen to go over it, it's, you're going to have to pay it. But no reason not to do that.
Yeah. They might not look back and say, well, wait. Your income 2 years ago wasn't because you were working. It was because you did Roth conversion.
They could. So it's like a Roth conversion probably technically wouldn't count. It's, not considered a life-changing event.
Right.
Or you sold a home and had a big gain in it, things like that. Those generally still apply, but it's up, between you and what you want to tell the Social Security Administration on that. But I can tell you this. Retirement does count from earned income. That definitely does count. Yeah.
Sure. Yep. Love it.
Excellent. Yep. All right, guys. Well, that's all I've got for you today in terms of questions from our listeners.
All right.
Appreciate you guys giving us some good info here as well. And appreciate our listeners for sending these questions in. We always appreciate that. And any final comments from either one of you?
Steve, when I was thinking through this and I kind of mid-episode may have, maybe we could tease that commentary out and just put it here at the end again, because the message is worth repeating, okay? And the message is this: there is so much complexity to each pieces of these, even these 3 questions we answered today.
Oh, I know.
There's so much complexity to it all that you have to have a process. So you have to have a process for digesting and analyzing all of the information in a way that is interactive with the other pieces of your financial plan. Now I'm just talking about dollar signs, decimal points, regulations here. But then there's the other piece of it too, that's emotion and relationship between spouses, kids, parents, grandkids, passions, desires, dreams, goals, all those things. Prior history and how you've responded in difficult times, whether it was in market times or geopolitical things or even health issues or family issues that have come up. All of it matters. It all matters in having a comprehensive financial plan put together that is looked at by a professional, hopefully a fiduciary, and updated on a regular basis so that when you come down to it, that you cull out the decisions that need to be made on a yearly basis, and you help families walk through this. You do this as a prudent steward of your resources and make those right decisions each and every year based on the information that you have in front of you. So much complexity with all this, but we can get beyond the complexity to a simplicity of a financial plan that says, hey, look, here's what we looked at. Here's the decisions we made. Here's why we made those decisions. Now let's go live life and not worry about it again for 6 months or a year till something either changes or we have to sit down and do our financial plan, keep that thing updated on a minimum of an annual basis. So I love these shows because it demonstrates all of the angles that you have to look at. And I'm so grateful that of our, I don't know, Matt, what is it, a bench of around 20 now financial planners at Keene? We're getting close to, I think, around 20 financial planners at Keene that come together on a regular basis in multi-week multi-day per week trainings and bouncing best practices, and the power of that team and that the brain power of the team collective entity coming together with, with your leadership, Matt, and others, Sherry's and myself too, and the other senior planners there at the firm. It's a very powerful enterprise. And we literally take that knowledge base and we just laser-like focus it on each client's personal situation, whatever those details might be. And that's why I think, this process is so successful. Again, whether it's with Keen or a firm like ours, really powerful to have a process in place like that.
Yeah. And I think one of the special skills that Keen Wealth has is taking all these things that can be super complicated and really clarifying them and simplifying them in a way that other people can understand, because you guys spend all your time figuring all this stuff out. The people that come to you are like, I don't want to deal with this. I'm not an expert in this. I don't want to spend my time doing this kind of stuff. And you guys are able to take the complicated stuff and explain it back and describe it and lay it out in a way that people can understand and that makes sense. And I think that's one of the values that financial advisors bring to their clients, is this ability to take something complicated and make it more simplified to the simplest level that it can be, but still understanding all the nuance and everything in it. So very, very important there. So guys, as always, thank you for taking the time here to be on the show. And I want to thank each of you listeners listening to this and watching this. We appreciate each and every one of you. And please make sure that you tell your friends and colleagues about the show, both the podcast and the YouTube channel. You can subscribe to both of those and be notified whenever a new episode comes out. And we appreciate that. And as always, if you have any questions or comments, please send them to us at keenwealthadvisors.com. You can find lots of ways to connect with us on the website. And we always love to answer listener and viewer questions with that. So again, thank you guys. Thank you, listeners. And we'll catch you on the next episode of Keen on Retirement.
All right. Thanks, Steve. Thanks, Matt.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.